Unit 1, Introduction to the National Flood Insurance Program, the birth and purpose of NFIP. The National Flood Insurance Program was created in 1968. Congress realized that private insurance companies could not sustainably provide flood insurance due to the catastrophic nature of flooding. Before NFIP, flood victims relied entirely on federal disaster assistance, which was expensive and unpredictable. The program operates on a simple principle. Communities that adopt and enforce floodplain management standards get access to federally backed flood insurance for their residents. NFIP has three main components that work together like a three-legged stool. First is flood insurance, which provides financial protection to property owners. Second is floodplain management, which reduces future flood damage through smart development practices. Third is flood hazard mapping, which identifies where flooding is likely to occur. Remove any one of these components and the entire system becomes unstable. The program is administered by FEMA, but operates through a public-private partnership. Private insurance companies sell and service the policies, while FEMA provides the backing and sets the rules. This arrangement spreads the risk while maintaining government oversight of this critical program. How communities participate. Community participation in NFIP is technically voluntary, but it is practically essential for most communities. Here is why. If a community does not participate in NFIP, residents and businesses cannot purchase flood insurance. More importantly, they become ineligible for most federal assistance, including disaster relief, FHA mortgages, VA loans, and federal grants for development in flood-prone areas. When a community joins NFIP, they are entering into a contract with the federal government. The community agrees to adopt and enforce minimum floodplain management standards, and in return, FEMA makes flood insurance available to property owners in that community. It is important to understand that the community itself does not buy insurance. Individual property owners do. The enrollment process begins when FEMA conducts a flood study and creates flood maps for a community. The community then has 1 year to adopt a compliant floodplain management ordinance. During this time, residents can purchase flood insurance, but it becomes unavailable if the community fails to join the program. Understanding flood insurance basics. Flood insurance differs fundamentally from homeowners insurance. Standard homeowners and renters policies specifically exclude flood damage. This means that water damage from burst pipes is covered, but water damage from a river overflowing its banks is not. Many people learn this the hard way after a flood. There are two types of flood insurance coverage: building coverage and contents coverage. Building coverage protects the structure and items that are permanently attached, like built-in appliances, carpeting, and cabinetry. Contents coverage protects personal belongings, like furniture, clothing, and electronics. These are separate policies with separate limits and deductibles. One of the most important things to remember about flood insurance is the waiting period. There is typically a 30-day waiting period before a new policy takes effect. However, there are exceptions. If you are buying insurance because of a new map that puts your property in a high-risk area, or if you are getting a mortgage that requires flood insurance, the policy can take effect immediately. The Community Rating System, or CRS, is NFIP's incentive program for communities that go beyond minimum requirements. Communities can earn discounts on flood insurance premiums for their residents by implementing additional floodplain management activities. These activities might include maintaining open space in flood-prone areas, providing flood warning systems, or conducting public education campaigns. Discounts range from 5% to 45%, making CRS participation very attractive to communities. Key definitions. You must know understanding NFIP requires mastering specific terminology that has precise legal and technical meanings. The base flood is the flood that has a 1% chance of being equaled or exceeded in any given year. This is commonly called the 100-year flood, but that name is misleading because it suggests the flood only happens once per century. In reality, there is a 1% chance every single year. Over a 30-year mortgage, there is actually a 26% chance of experiencing a base flood. The base flood elevation, or BFE, is the computed elevation to which floodwater is anticipated to rise during the base flood. This is typically expressed in feet above sea level and is the benchmark for most regulatory requirements. If the BFE at your property is 105 feet, that means floodwater is expected to reach 105 feet above sea level during a base flood. The Special Flood Hazard Area, or SFHA, includes all areas subject to inundation by the base flood. This is sometimes called the 100-year floodplain. Most regulatory requirements apply within the SFHA. The regulatory floodway is the channel of a river or stream, plus the adjacent land areas, that must be reserved to discharge the base flood without cumulatively increasing the water surface elevation more than 1 foot. Historical context and evolution. The NFIP was created in response to a series of devastating floods in the 1960s, particularly Hurricane Betsy in 1965, which caused unprecedented damage in Louisiana. Congress realized that the cycle of flood, rebuild, flood was unsustainable, and that better planning was needed to reduce flood losses. Initially, the program struggled with low participation rates. The Flood Disaster Protection Act of 1973 changed this by requiring flood insurance for properties with federally backed mortgages in high-risk areas. This requirement dramatically increased participation and made the program financially viable. Hurricane Katrina in 2005 was a watershed moment for NFIP. The program paid out over $1.6 billion in claims, demonstrating both its importance and its financial challenges. This led to reforms including the Biggert-Waters Flood Insurance Reform Act of 2012 and the Homeowner Flood Insurance Affordability Act of 2014, which attempted to make rates more actuarially sound while maintaining affordability.